Inflation is up substantially. The headline CPI looks significant enough, but you have to look at what's happening with core inflation. Look at how much the month-on-month core inflation shoots up in April. It's almost comical. As you can see, the figure is the highest it's been since 1980 or 81. So it's the highest it's been since the 70s inflation. And the way it just shoots up like that, it's almost comical. And that's after another spike immediately after the recession. Of course, at the time, since it was immediately after a severe dip, it didn't mean as much. But there hasn't been any deflation the last couple of months, so this spike fully means what it looks like. Look at its surge, it's almost comical. Now, a couple of months back, if you look at this video, which I'll link in the description, I said that inflation was coming and that it was going to stay high, and I'm just going to take this moment to point out that I was right. So you should have been paying more attention to me in the past. I mean, it was obvious that because of how much money they were printing, and because they were putting it into the pockets of actual ordinary consumers instead of letting it sit collecting dust in some obscure financial bank accounts, that this time the increase in the money supply would translate into inflation. It has to. I mean, the only alternative is that we've come up with the equivalent of some sort of economic professional mulching machine in which we could give people all the goods they wanted for free with no cost and without having to produce them, which was just absurd. So anyway, inflation is high. Substantially. So anyway, continuing with what I'm talking about, what I'm going to say is that inflation isn't even done increasing. It's going to go up substantially from here. And you know how I know this is because of rents. Right now, the increase in housing cost, or owner's equivalent rents, as it's used on the CPI index, hasn't been increasing much. As you can see, in April, it increased 0.2% month on month, which is around where it's always been performing for the past decade. So far, home price inflation in rents is still within the normal levels that's been over the past decade. Now, what's been happening with house prices is that they've been soaring. They've been increasing substantially. So looking at the S&P Case-Shiller index, home prices have been increasing about 1% a month, which is 8 times the increase in rents that we're seeing on the holders equivalent rent. And let me explain myself further. You see, the consumer price index does not track yearly mortgage costs or housing prices. It tracks owner's equivalent rent. And owner's equivalent rent is basically a made-up price that owners of homes pay themselves that's calculated in the CPI index, even though homeowners don't pay rent, they pay yearly mortgage costs. And when I learned about this, I realized that, okay, the actual CPI numbers are cooked because there is no way you would use this ridiculous imaginary measurement for housing costs unless you were trying to massage the numbers and get away with something. But that's a tangent that's irrelevant here. So anyway, what's been happening so far is that because mortgage rates have been declining, so the pre-pandemic level was like 3.7%, and they fell as low as 2.6%, even though headline house prices were up, the lower mortgage costs meant that interest payments were lower, and so the yearly mortgage payments that people had to pay to buy houses was still declining. So a decline of mortgage rates by 1% or 100 basis points means that your yearly mortgage payments decline by like 20, 30%. So if house prices go up 10%, but otherwise your yearly mortgage payments go down 30%, then that means you're still paying 20% less for your mortgage payments. But what's been happening is that house prices have continued to rise, and mortgage interest rate costs have gone up a little bit from their all-time lows. So they bottomed out at 2.6%. Now they're at 3%. So between those two factors, the yearly mortgage payments have risen to above their pre-pandemic levels. And house prices are continuing to increase 1% a month. And because mortgage rates are getting lower, that means that now yearly mortgage costs are also concurrently increasing 1% a month above the pre-pandemic levels. So what this means is that the cost of rent has to start increasing at the same rate as the cost of housing, because yearly mortgage costs are now above the pre-pandemic levels. So they're no longer acting as a downward pressure on rents. And so, because they're above their pre-pandemic levels and increasing 1% month to month, that means they're going to have to pull rents up at a similar rate because of just basic market arbitrage. And the fact that the higher monthly mortgage costs are now going to push people onto the rental market until rents rise to a point where you no longer get a discount for renting. So you know how rents have been increasing 2% a month? Well, soon it's going to match the rise in housing prices and increase 1% a month. And since rents are a whole third of the CPI, that means that the CPI is going to increase 0.3% above whatever it is. So you see the 0.9% increase? Well, now that's going to be 1.3% increase month on month once rents catch up to house prices. So the increase in the CPI is only going to go up from here. And at this point, we're entering a stage where inflation becomes self-reinforcing. Because once ordinary consumers realize that there's going to be substantial inflation, even if they only think it's going to be for this year, they're going to move forward their purchases that they would have otherwise made ahead to right now in order to try to get ahead of inflation. Which means that the purchases people make are going to increase substantially, and consumers have a huge amount of savings to fuel purchases with. And once it happens, that means demand is going to increase even more, and the velocity of money is going to go up. And those two things mean there's even going to be more demand generated for money, and so there's going to be an even higher increase in demand and more prices, and inflation becomes a positive feedback loop and self-reinforcing. And similarly, the high unemployment benefits mean that even though headline unemployment is high, and the real number is even higher because of all the people who dropped out the labor force, functionally the market is functioning as if there's full employment, so wages are going to increase substantially, and that's going to lead to shortages until prices rise enough to fuel an increase in labor costs. So inflation is only going to go up substantially for the next year, and there's going to be enough inflationary pressure in the economy so that inflation becomes self-reinforcing, and inflation has an escape to avoid the transitory nature of the supply shortages. Because once demand increases enough, it doesn't matter if the supply of commodities increases if there's still a labor shortage. And there is going to be a labor shortage in both the United States and in China, because China is out of new labor to throw into factories unless wages rise substantially. And there is nowhere else to offshore production other than China because Vietnam is too small. If 10% of Chinese export capacity goes to Vietnam, suddenly Vietnam's per capita output is more than double China's. So wages in Vietnam are going to rise more substantially. And there's nowhere else to go other than Vietnam. Wages in Thailand and Malaysia are already higher than in China. Wages in Indonesia are higher than Vietnam, and Indonesia has substantially worse infrastructure than Vietnam. Cambodia and Laos are way smaller than Vietnam. Myanmar is going into civil war. India has substantially worse infrastructure than Vietnam, and other structural issues. And because exports are a much lower proportion of the economy, it has a much lower economics of scale in its export sector, so prices are going to be higher from that factor, even if the infrastructure quality was of equivalent quality. And again, Bangladesh has lower wages than India, but the country size is much smaller. So there is nowhere else to re-offshore exports other than China, so you're not getting costs any lower than what the Chinese level is anytime soon, and probably never, because I doubt Africa will ever have as good infrastructure and economic scale as China. Or if it'll be or if it ever does, it'll be after Africa's developed substantially, and African wages have risen much higher than they were at the equivalent Chinese levels when China was at its peak export cost competitiveness around the late 2000s. Because in the late 2000s, China had top-notch infrastructure, but it still had very, very, very low wages. Now wages in China are higher substantially, and no developed country is probably ever going to have equivalent high-quality infrastructure at the same low wage levels China had. So to wrap it up, inflation is only going to go higher from here, and we're just seeing the beginning of this. And because of higher housing costs, and the fact that the mortgage rates are no longer acting as a buffer, yearly mortgage costs are increasing at 1% a year, and they're now back above pre-pandemic levels, which means rents are now going to rise at 1% a year, which means the monthly CPI is only going to get substantially higher from this point. So yeah, that's it. Inflation is substantially high, and it's only getting higher here and out.